Welcome to meeting number 8. We're going to look at managerial accounting, starting on page, let's see here, looks like page 127, chapter 9. We've covered 8 chapters, so we're going to look at chapter 9 and chapter 10 in this brief video. Managerial and cost accounting. Now, I've already talked about managerial being internal. Financial accounting, which is the first 8 chapters in this book, is all about financial accounting, external reporting, following GAAP, right? Very important. Chapter 9 and chapter 10, only 2 chapters, are about managerial accounting, which is internal reporting. Yes, you follow GAAP for a lot of this, but then at the same time, there are certain things that you can take the numbers and use to manage your business however you want. And it doesn't have to be GAAP. Contribution margin is one way that we're going to look at, which is in chapter 10. But let's first look at chapter 9 there, starting on page 128. Actually, on 129, after he talks about the real world, he talks here about managerial accounting and financial accounting, cost accounting, which is what managerial is. In the old days, managerial accounting was known as cost accounting. And that's what he refers to here in tracking costs and performing cost analysis. And on page 130, he goes into detail here about who uses managerial accounting and who uses financial accounting, right? Very important there. The users, the guidelines for preparation. You can see GAAP is used for financial. It's also used for managerial in a lot of ways, but at the same time, it's flexible enough that you don't have to use GAAP in order to make decisions. And your frequency of preparation, obviously annually and quarterly or monthly for financial accounting. Managerial is just as needed, maybe every day. There's a lot of cost accounting reports that I would generate as a controller on a daily basis to manage the business. Budgeting is a big part of managerial accounting, although it has to roll up into financial, and of course you have to follow GAAP when that happens. Independent review or opinion is external, as your external auditors. Of course, you have internal audit that assist you there, but there is no requirement that someone audits your contribution margin statement or anything. It's just up to you to manage your business. A lot of things go on in management accounting, more than I have time to talk about there on page 131. Total quality management is a big part of manufacturing. Internal failure, external failure, your prevention costs, and your appraisal costs, those 4 comprising the total cost of quality, total quality management, the 6 Sigma, which is process variation, and your lean manufacturing, which is throughput, velocity through your, as you pull in a pull inventory system, as you make your product based on customer demand. We'll talk a little bit more about that later on in some other chapters, but that is a part of what managerial accounting and cost accounting is. The Institute of Management Accounting is the bottom of page 131, which I'm a member of because I am a CMA, bottom of page 132. That's a professional designation. It's a national exam. It's not a license. It's a professional certification on a national level. CPA is a license that you take state-driven, like we have the TSCPA in Tennessee. Goes on at page 133. Cost accounting, cost concepts, preparing bids and proposals, budgeting. I talk about capital expenditures, bottom of page 133. That was something that came up in our case there on revenue recognition. That was one way that WorldCom was taking items that were expense and capitalizing that, meaning they took it off the income statement as an expense and put the debit there as an asset to be depreciated over many years to boost income. And so that is something that controllers are always looking at as being managing capital expenditures in addition to those other items listed there, especially budgeting. We use a term there on page 135 called absorption costing. Absorption costing. What is absorption costing? Well, remember back to your 2020 class, and maybe if you took 3090 here at ETSU, a big part of that was probably 2/3 of 2020 was managerial accounting. And if you recall, managerial accounting, cost accounting in a manufacturing environment, you have your inventory, which is a combination of materials, labor, and overhead. Direct materials, direct labor, and overhead, right? Remember those three? The big three. And those costs were accumulated in inventory and they were on your balance sheet as an asset until when? Until sold. And then it came off your balance sheet and went to your income statement as cost of goods sold. So the debit came out of inventory and went to cost of goods sold, didn't it? Yes. So those are the big three. And when it's talking about absorption costing, that means you're absorbing all the costs associated with your facility. As a controller of Exide in Bristol, our plant, every cost in that building, every expense was considered full absorption costing. That's what GAAP requires, that all of that associated with your manufacturing process that's going into your product, whether it's a fixed cost or a variable cost, which we'll talk more about in chapter 10, whether it's fixed or variable, it all got grouped into your absorption cost. Now there's also what's called variable costing, that you don't have to worry about. That is not a GAAP approved method, but absorption costing is very important to understand that direct material and direct labor, walking a shop floor, you can tell what those two items are, direct materials, direct labor. The third one, overhead, is the one that is not specifically identifiable cost for your product. So if I'm walking through the production area and I'm seeing material and labor in that department, very easy to identify, it's traceable. But all that overhead, like electric bill, our electric bills are $400,000 a month. A lot of money. And we have maintenance and repair, that's probably another $500,000. But all of that got grouped together as a pool and then allocated to your product as you manufactured it. How did you allocate that? Usually there was a cost driver like direct labor that would be used for that. Direct labor, maybe machine hours in your production area. But that overhead pool had to be allocated. That's what absorption, your product costs had to absorb all that overhead into it, right? Your overhead might be 50% of the total cost. You got labor and material, and then the overhead might be a big part of that or a sizable amount. But that's what absorption costing is, taking your overhead and applying it to your product. Page 136, talking about a job shop. That's usually if you have a construction site like building a stadium like we have here at ETSU, the football stadium, that would be like a job shop. Or if you're building yachts that are, every one of them is different. You're accumulating the cost by your job order. But if you're a bottler like Coca-Cola, or if you're a manufacturer of batteries like Exide, or automobiles, whatever that might be, that is a process cost with all your working processes. You still have overhead, you still have direct material, you still have direct labor, but it's a little bit different how you accumulate those costs. Page 139 talks about process costing. They go into a concept there called equivalent units. Well, what is an equivalent unit? It's a weight to cost based on every department, although it may be manufacturing something that doesn't even look like the other department because it's part of the process to build. Equivalent unit enables you to actually analyze that what you're building cost-wise is equivalent from one department to another. Like, what is your cost per equivalent unit? You would have covered that in 2020, and I'm not going to go into that much detail again. But what I had at Exxon, I had an industrial engineer that worked for me. Some people are surprised to know the engineer would work for an accountant or controller, but that engineer was responsible for time motion studies. He was always out on the production floor, and it was the same way at Lear, Exide, very similar. Because all these processes, even though you've got a lot of computerized technology in these plants, it's still, there has to be a human element that uses that equipment and that technology. So we would, based on direct labor for each of our processes, develop these labor standards. And that's what the industrial engineer did. Industrial engineer time motion studies. And he would develop these standards for us to gauge how we allocate the overhead and also how to manage our business to see if our direct labor was efficient or not. And that's a good point to see there. And again, this just shows you how accounting is just touching every aspect of what happens in an organization. An engineer working for accounting, dealing with production and operations. Anytime there's a major decision to be made, or just routine decisions for that matter, something that happened on a regular basis, the key people involved were always the plant manager, the production manager, the controller, and the materials manager. 4 people. We didn't involve HR, environmental, didn't involve engineering, health and safety, quality, distribution. They weren't involved in these high-level meetings, because if you've got your plant manager and the other 3 that worked for him, again, was the controller, the financial person. He knew more about the operation than anyone. So you had the controller or accounting, you had production, right? They're the ones making it happen. And then you had materials, supply chain. Although the distribution wasn't important. Those 3, in conjunction with the plant manager, were the ones that were making the decisions, setting forth the strategic plan each year. So the more you know about these individual areas that are separate from your knowledge, the more successful you're going to become. And so on page 141, activity-based costing. Sounds good, but not many companies use it. It's very expensive. So if you're going to embark on something like that, you've got to decide whether it's worth the effort and the cost, obviously, and what you're going to reap as far as a return on your investment. And so that brings us to chapter 10 with cost behavior. I heard about cost behavior. How does cost behave? Well, it's really either one of 2 things. It's either a fixed cost, meaning I've already paid for it at that level. I can't get it back. It doesn't matter how many units I make, like lease, like rent expense, or depreciation. Salaries for people, that's pretty much a fixed cost. It doesn't vary based on your production volume over the relevant range, key term, relevant range of production. Then you got variable, which varies exactly how your volume varies, like direct labor or your direct materials. That varies 100% in relation to your production volume. And so that's why when we look at chapter 10, we're talking about the contribution margin approach to how you analyze your business and making smart decisions. Contribution margin has nothing to do with GAAP. It has nothing to do with external reporting. It's all about internal reporting and managing your business. What is your break-even point for various products that you're making? What's your break-even? How many do you have to make to break even? How many Subway sandwiches does the local franchise have to make to cover all their fixed costs in 1 month or 1 day, right? If you take your lease for the month, your electricity, insurance, and you probably throw salaries in there as being a fixed cost, because they're there, add all that up, and whatever that is for a day, of course, divide your rent by 30 days or 31 or whatever. What is your fixed cost per day? And then how many sandwiches do you have to sell to break even, right? That's what any smart person would do before they embark on a franchise in a certain location. So this chapter 10 is very relevant, cost behavior. Page 148, 149, they go into some more detail there, but it really comes down to how does this relate to what we've been learning? And I went ahead and prepared this to show you very basic financial accounting at the top from the dotted line up. We start out in 2010, back when you were in principles, learning what revenue minus expense is income. And then we have what? Out to the right. Revenue minus cost of goods sold, wrong side. Revenue minus cost of goods sold, gross margin minus selling general administrative is income. And this applies to either a manufacturer or a retailer, merchandising, right? Revenue minus expense, what's my gross margin? But now in chapter 10, because this is sort of a financial and a managerial grouped in one, but this is acceptable. This is what most companies that are doing external reporting are using if they're a manufacturer or a merchandiser. But when you get down below the dotted line, this is entirely managerial. Revenue minus variable cost is contribution margin, minus fixed cost is your income, right? And so all you're doing there is taking these expenses up here and breaking it out and what part is variable and what part is fixed. And sometimes you got a cost that is part variable and part fixed. Well, that's fine. The textbooks call that mixed cost. But again, that's needs to be broken out here to show what your break-evens are. So what's the break-even calculation? Well, that's over there on page 152. And there on 151, it shows you what I've just put up there on the screen. Look at the top of page 153. Whatever your total fixed costs are, divided by your contribution margin per unit is your break-even. Like, what if I had total fixed cost of $100,000? Fixed cost of $100,000, and let's say my revenue per unit was $100, and my variable cost was $50. So my contribution margin is 50, right? So what's $100,000 divided by 50? I'm not very good at math, right? Was that 2,000 units? You can read that. If my revenue is $100 per unit and my variable cost per unit is 50, that means every unit I make, I'm contributing $50 toward covering my fixed cost. So my $100,000 of fixed cost divided by $50, right, tells me I've got to what? I've got to sell 2,000 units to break even. And at 2,000 units, I have neither profit nor loss. That's what they're saying there on page 153 up at the top. But read this. It's very straightforward and will help you in understanding if you decide to start your own business and make some smart decisions. All right, break even with multiple products and so forth. So that is pretty much chapter 10 that I want to cover. So chapter 9, chapter 10, managerial accounting. That's the shortest lecture you'll ever hear on that area. Just a brief review of that, of what you learned in 2020. But if you have questions, ask. Email me and I'll get back with you as soon as possible. I hope you have a good day.